So kind of a funny story. A few years ago, we acquired a book of business, and I was taking over the commercial book for a producer who was retiring, and he had a very loyal book of business, and a small commercial client, a bookkeeping accounting firm, called me up one day. It was a sole owner, and she had just sold her business to me. Sold her business, and she said to me that she wanted to cancel her policies. So we got to talking a little bit, and I noticed she had an E&O policy and an employment practices policy. I said, okay, let's just talk about some premiums for an extended reporting period. She said to me, she goes, what? She goes, maybe I wasn't clear. She goes, I'm done. I want to cancel my contracts. I don't want to pay any more money. It was kind of funny. She was getting pissed at me. So I said, man, we need to talk about this a little bit more. You may still be exposed to liability issues due to the types of policies that you have and the terms and conditions. So let's talk about this a little bit. For those that may be familiar with purchasing, insurance or been involved in any insurance contracts, here's a common list of policies that a business may have depending on its operations. So this could be any type of business. You have general liability, you have auto, workers' compensation, errors and omissions, cyber liability, D&O, and employment practices liability. And I'll give you, when I talk about claims examples, I'll give you a brief description of the purposes of these policies in the coverage triggers. But for purposes of this discussion, we're going to be looking at various liability insurance contracts and the claims reporting conditions with respect to how they can affect a business after it's closed or sold. So from a very high level, there are two different types of liability coverage forms. And here I'm going to break them down, and they're called occurrence forms and claims made forms. And while there may be some cases where the types of policies listed here may be written differently, we most commonly see these policies on this side, E&O, cyber, D&O, and EPL, are written on claims made forms. Okay, so what does that mean and how do they work? Well, it's a condition within the contract that dictates how coverage is activated. It's based on when an incident occurs or a claim is made. So this image here makes it a little easier to understand. The top is showing an occurrence policy, and the bottom is showing a claims made policy. As you can see here, both policies have been have the same, let's just say they've been on the same terms and have been canceled 2 years into the policy, being from the inception date or from the date that they were purchased. So simply put, the occurrence form covers losses that take place during a specific period, regardless of when an incident is reported. So as long as there was an active policy when the incident occurred, the claim will be covered even if it is reported after the cancellation date. On the contrary, you see the claims made policy down here. The claims made form covers incidents that you report during the active policy period and after the retroactive date. So let's just say a retroactive date, for anybody who doesn't know, it's a specific date that the policy's coverage begins. There's generally, this is generally the date that the policy is purchased, or in some cases can be a past date that is agreed upon by the policyholder and the insurer. If an incident occurs before the retro date, it won't be covered. So claims through this type of policy form of coverage must meet both of these criteria to apply. So if coverage ends and a claim is made after the expiration date, it might not be covered unless further action is taken. I mean, I should say that it is the intent of the form not to cover it. So something needs to be done about it. So to gain a better understanding of the reality of this issue, I'll just take you through some of these policies that I mentioned that we commonly see written on claims made forms, and give you some claims examples. So you see here that we'll start with D&O. Simply, D&O covers directors and officers for claims made against them while serving on a board. It could be for a number of different entities, not-profit, for-profit, privately held public entities, and educational institutions, it's also known as management liability, where policies cover claims resulting from managerial decisions that have adverse financial consequences. So this is a claimed example. A few months after purchasing an insured company, the purchaser filed suit against the company and its former directors and officers for alleged fraud and conspiracy to commit fraud. The plaintiff alleged that prior to the sale, the defendants conspired to withhold crucial information regarding deficiencies in one of the company's products, causing the plaintiff to greatly overpay for the company. Moving on to another policy written on a claims-made basis is an employment practices liability policy, which covers wrongful acts arising out of employment processes. Most frequent claims that we see are wrongful termination, discrimination, sexual harassment, workplace harassment, retaliation, and breach of the employment contract. So in this example, we say a business owner who has lost interest and wants out needs to take a savings action as the sales are down. He decides to lay off 3 employees. A buyer comes along, the business is sold 3 months later. Another 3 months go by and the former owner receives an MCAD complaint and alleging age discrimination and suffered damages from all 3 employees. The former owner needs to hire an attorney to assist in the writing of the position statements. So actually, this is a very similar claim that I'm dealing with right now from a company that was sold. So this stuff commonly happens. I mean, we hope it doesn't happen frequently, obviously, but it does. I've seen it at least twice in my short 8 years of being at Tarpey Insurance Group. Another one, E&O, otherwise known as professional liability, in some cases malpractice insurance, protects a policyholder against liability for committing an error and omission in performance of the professional duties. In this example, we say a tax preparer neglects to file a required form, which is not discovered until 3 years later, and the firm has been sold. The client demands that the preparer pay resulting interest and penalties. So in all 3 situations, we have defense costs and significant problems that could lead to damages being paid out. So how do we resolve this problem? We need to examine the options provided with these policies. They're called extended reporting periods, sometimes referred to as tail coverage or runoff coverage. The extended reporting period is a designated time period after a claims-made policy has expired, during which a claim may be made and coverage triggered as if the claim had been made during the policy period. In most cases, there's an automatic extended reporting period with a cap of usually, I mean, every policy differs, but it could be 30, 60, or 90 days that's automatically provided. But to go beyond that, companies will charge a percentage of the expiring premium to purchase that actual tail coverage. So I'm going to see if I can just share this other quick thing here. Hold on 1 second. Sorry, I don't know if I can do it or not. Actually, can everybody see that, Tom? Okay, good.
That looks great. Yeah, perfect.
Right.
Thank you.
No problem. So this image is information on the tail coverage from a lawyer's professional liability policy that I write. And as you will see, there are a number of different links to choose from, with the corresponding factors that will be applied to the expiring premium for a one-time payment for the tail coverage. So yes, this can get very expensive depending on what your expiring premium is, but my point is to say that if you don't do it, if you don't know it and don't buy it, then you could be stuck with a lot of out-of-pocket expenses to defend these issues that come along. It's not something that we want to see or deal with after we have a nice payout from the sale of a business in our pockets. So you know, I'll conclude by saying that, you know, this topic is fairly straightforward for our clients to understand once it's explained. But there's a lot more to consider before even getting to the conversation of buying a tail policy or, you know, buying the extended reporting period. As you may know, that there are very many different insurance companies not all products are treated equally, especially in these specialty lines of D&O, E&O, EPL, cyber, fiduciary liability. So while I'm biased, I'm going to give you a little bit of a sales pitch. I think it's very important to navigate these with a knowledgeable insurance agent, independent insurance agent. I know there are online platforms where you can buy these contracts, and in my opinion, these are dangerous without a thorough review of the coverage triggers and the conditions. So most independent agents have the client's best interests, so please do encourage your clients, if the insurance topic ever comes up, to reach out to Cindy, to Kate, or myself, or Mike and Kim on the life and disability side. It's our number one priority to evaluate these exposures and risk and provide quality coverage and help guide you through the claims process. So that's pretty much all I have. Thank you very much for your time. I'm happy to answer any questions.